Coming in, HDFC Bank has reported a mixed bag in the third quarter. Abhishek Kothari is here with the numbers. Abhishek, over to you.
Well, it looks like a mixed set of numbers coming in from HDFC Bank. They only had 1.9% sequential growth in deposits, and their interest expense is up 4.5% quarter on quarter. And it looks like this might have hurt their net interest margin. Net interest margin was likely to remain stable at 3.4% as per Nomura estimate. However, the NII growth on a sequential basis is lower than that of the loan growth, which means that there might have been compression in the net interest margin. The NII at 28,471 crore is 2% below our poll of above 29,000 crore. So net interest margin might have hurt on the top line. Other income has remained stable. Operating profit growth is of 4.2% quarter on quarter. However, despite the fact that asset quality has improved, provisions are up more than 45% quarter on quarter, suggesting that credit costs might have spiked up, and this provisions has actually impacted the PBT. So PBT, profit before tax, has seen a decline of 1.8%. Now, tax outgo was supposed to be on the higher side. However, it's worked on the reversal, and so tax rate in this quarter is 15.7% versus 19.3%, and that lower tax has actually aided the profit to be higher than our poll. Our profit has come in at 16,373 crore. We're working with a number of 15,600, 15,700 crore. So lower tax outgo has actually aided the profitability. In terms of asset quality, gross NPA and net NPA in absolute value is down 1.8% quarter on quarter and more than 5% sequentially in terms of net NPA. So gross NPA ratio and net NPA ratio both have improved sequentially, and PCR has also improved. That is provision coverage ratio, that's also improved. So asset quality, no hiccups seen. However, the spike in provision and lower net interest margin could actually weigh on the stock price tomorrow. Back to you.
All right, Abhishek, we are also joined by market expert Prakash Diwan on the broadcast. Abhishek, do you have any questions for the kind of numbers that HDFC Bank has reported for our guest?
Prakash, to begin with, the top line looks to be on the weaker side, especially due to a cost of funds that could have actually weighed on the performance. Your first take on the results?
So, Abhishek, first and foremost, thanks for such a sharp analysis of the numbers and so quickly while the headlines were being read out. You managed to cull out some very interesting changes in how it's behaved, how the numbers, parameters look on a QoQ basis. So let me focus right away on what might trouble the street in these numbers. So while cost of funds was likely to go up, has been up for mostly everybody, we always felt HDFC could get away with a slightly lower hike in fund costs, but that doesn't seem to have happened because you've seen the NIMs compress. Their inability to grow the book with any kind of personal loans, the side of the personal loans, and the way the RBI has clamped down on that segment also tells you that it's going to be difficult to pass on higher cost of funds in your credit growth, right? That's one thing. But on the profitability side, if you look at the lower tax outgo is so what the provisioning, the higher provisioning, the provisioning is almost like, if I get my numbers right, it's almost from 2,900 crores, it's close to 4,000 plus. So there's a 30%, 40% hike. So what the provisioning taketh away, the lower tax rate is giving in this case, right? So that's what's happened, is it got balanced out. But the integration that you are seeing on the ground, and then let me go straight away to what is it that the street would look forward to from the call and subsequently, is that this is the second quarter post the integration. And there is one thing that seems to have normalized, and that is there's absolutely no dilution in asset quality, whether it's on the gross NPA or the net NPA. So, which means that you don't anymore have surprises. They had alluded to this. They had managed some expectations, saying the quality could take a bit of a hit, which happened last quarter. But this quarter, things seem to have normalized on that count. Now, if the commentary is positive on credit growth, in which segments they are likely to grow, and if cost of funds can probably peak out, which seems like peaking out given the narratives from other bankers around what they expect the RBI to do and things like that, then you probably might be able to mitigate or live with this lower revenue growth, top line growth, because I don't think anybody has doubts that the margins have been under pressure, will be under pressure for some more time till interest costs remain elevated.
Well, Prakash, just to augur with your point, they have been the only lender who has actually grown their deposit base over the last 1.5 or almost 2 years now. Right from the time that they announced their, merger intention with HDFC Limited, their deposit growth has been north or ahead of the entire street or the sector as well. So it's difficult to gauge that, interest expenses right now hurting them, given the fact that they already have a huge base as well. I'll just come back to you. We also have Rahul Malani from Sharekhan joining us. Rahul, what do you make of the numbers in terms of the first cut that you have?
So, first of all, good evening. Overall, at NII level, it is 5% below our estimates. We were working with marginal improvement in NIMs by around 5 to 6 basis points, resulting from the release of the liquidity from the ICRR impact. But that has not played out. Rather than the margins are stable, and on that has resulted in the operating profit coming below at 4%. On the provisions level, if we look at the provisions, the core credit cost is stable at 49 basis points. So overall, additional 1,200 crore provisions have been maintained, have been included in contingent provisions. So, and at the PAT level, it has not translated into underperformance because the tax rate is lower. So overall, the margins are below expectations.
Well, Prakash, Rahul mentioned that margins are below expectation. Yes, Nomura was working with a flat net interest margin, 3.4% versus 3.4% in the previous quarter. Would you be concerned about the decline in net interest margin in the current quarter and subsequent pickup in the coming period? Would you give a thumbs up to that, or would you be concerned about the decline in net interest margin?
No, absolutely no. No, there's no concern. In fact, there was an expectation, and it's absolutely on those lines, given the fact that everybody is experiencing a peaking out of interest rates. Now, if the bank were to, let's say, roll out deposits or any kind of a liability side product with lower costs, I'm sure they're going to keep on getting the response. As you said, they have deepened the base, the investor base for their deposits in such a significant way that their presence today in the deposit market and wholesale and retail both is so strong, given the legacy of the HDFC Limited and the franchise of the bank, that I would believe they'll be the first to get any kind of an advantage that percolates to lowering of interest rates. So if that were to happen, and as I said, there has been a product mix shift which doesn't allow a bank which is very conservative, wants to focus on quality, to be able to pass on higher costs to borrowers, right? So you don't want to be doing that if just because your cost of deposits is higher. So I think from that perspective, this is the balancing out quarter, and for subsequent quarters, and I'm sure the commentary will give some sort of a clear direction in those lines, but the subsequent quarter would probably see an improvement in NIM. So if NIMs expand, credit growth expands, quality remains benign, your provisioning is absolutely sharp, there is no reason why the bank wouldn't get re-rated.
Well, thank you, Prakash. As you mentioned, this is a balancing out quarter, so one can take this with a pinch of salt and, look for improvisation in the coming quarters as well. Thank you, Rahul, for joining us. Back to you, Archana.
Thank you, Abhishek, for that, and a big thank you to our guests. On that note, we will slip into a short break. Stay tuned. We'll be back.